To understand why 25 major banks rushed into an emergency session, you first need to understand something most people never think about. Banks, Dante, actually run on money. They run on trust. And liquidity is simply what that trust looks like in the real world. Liquidity is the ability for a bank to meet its daily obligations, withdrawals, payments, loans, and settlements. But the important part is these banks don't keep the money you deposit. They invest it, lend it, and leverage it to create more money. So when liquidity dries up, the banks suffer. And liquidity problems are not new. They are as old as banking itself. The warning signs go back centuries. In 1792, during what historians call America's first financial crisis, liquidity vanished because of over-leveraged government bonds. In 1907, the U.S. saw massive bank runs triggered by liquidity shortages so severe that J.P. Morgan personally forced banks to cooperate to avoid collapse. And in 2008, the world learned the lesson all over again. Liquidity problems destroy banks faster than losses do. Losses can unfold over months, but liquidity evaporates in hours. Yet, despite the trauma of 2008, despite reforms, stress tests, and supposedly safer systems, the banking sector quietly rebuilt the same vulnerability. Over recent years, due to global shocks, rapid interest rate changes, and the rise of the shadow lending world, the system has become more fragile, more interconnected, and some argue dangerously opaque. The perfect conditions for another liquidity crunch. But here's the twist. This crisis didn't begin where we expected. It didn't start with failing mortgages or collapsing companies. It began with the one thing: banks are never supposed to run out of short-term funding, the oxygen of the entire financial system. And once that oxygen thinned, 25 major banks did the only thing they could. They locked the doors, closed the blinds, and held a meeting no one was meant to know about. To understand the origins of this crisis, we must rewind to three major developments, each seemingly unrelated, yet ultimately interconnected. First, interest rates didn't just rise. They whiplashed upward at the fastest pace in modern history that caused assets held by banks' long-term bonds, mortgages, and commercial loans to lose value far faster than institutions could adjust. It wasn't a problem as long as no one sold them. But liquidity shortages, forced selling, and forced selling exposes the truth. Banks were sitting on unrealized losses large enough to worry even seasoned investors. Billions became hundreds of billions, creating the first fracture. The second fracture came from the shadow banking system, private credit funds, hedge funds, money market funds, repo markets, and non-bank intermediaries. These markets are enormous, carrying trillions of dollars, but far less regulated. When liquidity tightens in these systems, the pressure pushes back into traditional banks through collateral calls, counterparty obligations, and settlement demands. Imagine a spiderweb. When one strand tightens, the other stretches. Stress in the shadows became stress in the banks. The third fracture formed when large corporations began pulling their cash out of traditional banks and placing it into money market funds, Treasury HIFs, and other short-term liquid products that offered higher yields. Deposits are a bank's cheapest, most stable source of funding. Losing them forced banks to rely on short-term borrowing, repo markets, and interbank lending, all of which can disappear in a matter of hours. Alone, these fractures were manageable, but combined, they became explosive. The rise of the crisis was slow and almost invisible. Banks quietly increased their dependence on short-term borrowing, which is like replacing a long-term mortgage with payday loans. It works until it suddenly doesn't. Collateral requirements tightened because the government bonds banks posted as collateral had dropped in value. Repo markets became strained as spreads widened and participants pulled back. Interbank lending flattened as banks stopped trusting each other. And then the SPOC. One major institution reportedly missed a key internal liquidity threshold and was required to report it to regulators. That alert triggered the emergency meeting. The breaking point was reached when 25 major banks met behind closed doors. They met because the short-term funding window was rapidly closing. Lenders shortened terms, raised rates, and became selective about whom they would lend to. Liquidity buffers, which were designed to last 30 days in a crisis, were being drained in less than a week, some in under 3 days. Cross-border banks demanded collateral early, triggering a vicious cycle where demanding collateral drained liquidity, which then created more fear, which triggered more collateral demands. And the most dangerous development of all, a large financial institution reportedly failed a margin call on interest rate derivatives. Derivatives connect banks like that. When one falls, everyone else shakes. The fallout began immediately. Banks moved to hoard liquidity by restricting lending, calling in loans, refusing to extend credit, and conserving cash. Smaller and regional banks became vulnerable to deposit flight, rising funding costs, and falling bond values. Regulators quietly drafted emergency backstops such as funding guarantees, relaxed collateral requirements, expanded lending windows, and temporary credit facilities. But markets reacted poorly not because they had bad news, but because they lacked clarity. Markets feared the unknown more than anything else. Efforts to fix the crises followed familiar patterns but failed for the same historical reasons. Injecting liquidity doesn't restore trust. Lowering collateral requirements signals weakness. Emergency credit lines help individuals, not systems. Quiet weakened mergers only hide weak banks, they don't strengthen the system. And this, Jimmy, the problem isn't one weak bank, but simultaneous stress across the largest institutions. Modern parallels reveal repeating patterns. The 1907 panic began with liquidity stress in trust companies. Today, it's in shadow institutions. The LTCM crisis of 1998 showed how derivatives can spread risk globally. Today's derivative exposure is even larger. The 2008 crisis showed how quickly collateral can lose value. Rate shocks have already caused deeper unrealized losses. The 2019 repo crisis showed how banks can suddenly refuse to lend. Today's repo volatility is larger. And the 2023 regional bank failures showed how deposit flight can destroy liquidity. Today, corporations are withdrawing cash even faster. 3 takeaways stand out. First, liquidity fails quietly, and then suddenly, banks rarely collapse due to insolvency. They collapse because they cannot meet short-term obligations. Second, complexity accelerates crime. What once took weeks now takes hours, and what used to be local now becomes global instantly. Third, we are not watching a single bank fail, but witnessing a system under strain, a network of relationships between institutions being tested. The emergency meeting of 25 major banks is not the end of the story. It is the beginning. Financial crises do not start with explosions, they start with warnings. Tightening liquidity, rising collateral demands, shrinking funding windows, and evaporating trust. Those who understand the signals see the world not as random events, but as patterns, warnings that repeat through history. Liquidity is the bloodstream of the global economy. And right now, that bloodstream is running thinner than anyone wants to admit. If this breakdown helped you understand how crises truly unfold beyond the headlines and into the mechanisms behind, then consider subscribing for more, not for hype, but for clarity. And if you want a full follow-up episode analyzing the potential outcomes of this emergency meeting, tell me in the comments. Stay informed, stay curious, and as always, thanks for watching.